Okay, so I have a class today to share with you, and this is one of my favorite trading strategies. So I've been in the markets for over 20 years now, full-time trader, and I started out as a swing trader. And I learned really early on I couldn't just buy like the 5-bar pullback into a 20-period moving average and expect to be really successful with it. So what I had to do was sit back, study the charts, figure out what was truly a strong strategy to trade. And it took a little bit of time, but I realized that by looking at core components of price action, I was able to develop a strategy that works really well no matter what the market is or what time frame it is that you're trading. I am just getting over a cold here, so if I pause to get a drink, that's what it is. So just a bit of a heads up here. All right, guys, so we are going to dive right in, and we're going to look at this pattern that's called a phoenix. So a phoenix is a reversal strategy. It's something where we are looking at a market that is about to break out of a trading range or is coming out of a strong trend, and we're looking for a reversal strategy. This pattern is actually one that is pretty simple. We are looking for a move coming off of the lows, a slower trading channel, and then a breakout. So you guys can do a screenshot of this. And what we're going to do today is look through each of the components that go into making a phoenix. So a phoenix starts out when we are looking for a reversal coming off of the lows, where we are first looking at momentum. We need to have an average to stronger than average move off of a low, and then we are looking for a gradual pullback or correction. Now, within that correction, it's really important to look at previous price action that took place in a security. Now, whether you're trading forex, you're trading futures, it doesn't really matter what market you're looking at. This is a pattern that can be part of an inverse head and shoulders. It can be part of a cup with handle, or it can be something where you're coming off of a pivot V bottom. When we look at momentum, an average momentum move that takes place in the security usually happens in the formation of a V. So what we want to look for as average is momentum on the upside and the downside, where when you get these V moves in the market, you have similar comparisons both directions. A lot of times that means overlap as it's heading higher, and very little overlap on the way down. So if there's not much overlap, then that tells me that the momentum is stronger than average. So for Phoenix, what we want to see is average to stronger than average upside off of a support level, and then more gradual overall momentum on the correction. So if a correction starts off stronger, like it does here, where it's average, stronger than average momentum, we want to see the overall channel begin to shift so that we have a slower than average pullback overall. So within this slower channel, it's perfectly fine to have some moves that are stronger than average. We just want this overall channel here to be slower than average. So when you transect that channel, you want to see momentum shifting. Now, trend development is the next thing that we're going to be looking at. So there's actually 3 places that a phoenix can form. You guys are most familiar with things like in inverse head and shoulders. And in the inverse head and shoulders, the overall trend channel will be a much stronger downtrend. And then you'll be looking for a reversal that basically turns around that entire trend. So you will see that move off of the lows where it's average to stronger than average, and then you will see that more gradual channel or pullback. So the phoenix is actually a break coming out of that channel. It can be that right shoulder in an inverse head and shoulders, or it could be the handle for cup with handle, or it could even be something where it is coming off of a pure V bottom. Now, which way it forms is actually going to be very important, because if you have this shift in momentum here before it goes into the Phoenix, you're much more likely to get a very strong trend reversal, where it's actually going to turn around the entire trend and give you a strong trend in the opposite direction. Otherwise, if it is a V coming off of the lows, like this, what you might end up with is that this only offers a secondary wave of continuation. So you might only end up with 2 waves coming off of that support before you see resistance hitting again, and maybe it goes into a trading range. So the rounding off or the slowing down into this low just before the Phoenix starts to form is really important when you're looking at a Phoenix that can lead to a major trend reversal. Not all Phoenix patterns are going to lead to major trend reversals, but all of them are worth trading and giving a shot. So another place that you can see a Phoenix form is often within a continuation pattern on a larger trend. So you might have an uptrend, for example, in place like this. And this is trending much higher. And you see a correction take place. And you'll get that little pop up off of the low, that little slower than average move, and then the Phoenix continuation. So the Phoenix is actually this little portion that can be part of a larger bull flag. It can be part of the little inverse head and shoulders pattern that's within a period of consolidation. And in a case like this, what I'm looking for is a tighter target. So I'm just looking for this first initial wave off the low, second wave as a continuation. If this has 2 little moves going into it, then you can look for 2 little moves coming out of it. But the most guaranteed portion is going to be that first initial move and then the second wave. Now, the next way that you can find a Phoenix forming is as part of a corrective move in a downtrend. So when that happens, you'll get an uptrend that's broken, you get the start of a downtrend, and you'll get a bounce off of support. Oftentimes this is going to be that V bottom I talked about. So when you see this V bottom coming off of a support level in something that's already turned around and you're starting to see stronger momentum on the downside, then you can still see a Phoenix form very, very often. As most of you guys are familiar with, we often see corrective moves that take place where you get a 2-wave correction and then you get a continuation of a larger trend, right? I know a lot of you have heard talk about that. This is a good example down here. You get a 2-wave correction and then the trend continues. 2-wave correction, trend continues. 2-wave correction, in this case, a little bit of head and shoulders, the trend continues. So this is something where you will see that Phoenix taking place, but it's on a much smaller time frame. So it will be part of this corrective move that can then lead to a continuation of the downtrend. So I will still trade this pattern, but in this specific zone within the trend's development, what you have the risk for is that the follow-through might not be as strong. So when we talk about where to place your target levels on this trade, I'm going to get to that here in just a minute. This is going to come into play because with a Phoenix that is part of a corrective move, sometimes that momentum coming out of it is slower than you would expect. So you might get a strong move into it, a slower move out of it. So I'm going to come back to this here in just a minute and show you guys how to manage it when that happens. Because even when that happens and the trade doesn't go as far or as strong or as fast as you want, there's ways that you can mitigate the risk on it. so that it's very rare that I ever take a full stop on this strategy. A lot of times if the trade doesn't work out for me, I end up being able to scratch it. And I'm going to show you the very technical way that you can do so that you're not just, jumping out only to see something turn around and work back in your favor again just a minute later after you're already out of it. So when we look at trend development, there's another aspect that nobody really talks about, and that is time development. Now, time development means that we are looking at how long a period of congestion takes to form before the pattern triggers. This is one of the biggest problems that a lot of traders run into. They'll get into a position too early, or the pattern will develop too long. And so it doesn't go at these ideal times where you want to see the triggers happening. With the Phoenix, the timing on it is oftentimes really easy because you can use a Fibonacci fan to help you with it. And that means that if you have a move off of a low where the momentum is average, then you can go and draw a Fibonacci fan from that low to that high. Now here's the trick. It has to be an average momentum move. If the momentum move goes like this, where you have hardly any overlap from one bar to the next on the upside, this trick is not going to work. So you want to have an average momentum move from the lows to the highs. That means decent overlap from one bar to the next, maybe some of these little swings as pullbacks within that channel, and that's going to give you an average momentum move. Now when that happens, 76.4 is the key level that you will find to begin to look for triggers on the Phoenix. So when we're looking at this as a Fibonacci development, oftentimes what you'll find is that Phoenix will take two waves to develop, just like a typical two-wave correction, but sometimes it might take another little test just to change the momentum that's happening within this consolidation itself. So like we saw earlier with the template, it's really easy to get a sharp reversal off of this first pivot here, but you want to see it change that momentum as the consolidation plays out. So the same thing happens over here in just reverse. You get, your turnaround, it starts to form the channel, and then it pulls back one more time before it goes. So that's something that you're basically looking at the reverse. Another way you can look at time development is also comparing the base of the Phoenix to previous zones of congestion or correction that took place in whatever security it is that you're trading. So in the case of the head and shoulders, it's really easy because all you've got to do is compare that right shoulder to the left shoulder. And as long as they're approximately that same amount of time development, then you're looking at the best level to get into the trade. It's not always the earliest level, but it's the most secure level where you won't have to worry about flushes. So you can see, if you just take like a two-wave pullback, it hits that 76.4% fan right here. But when you compare the time development over here to where that level is, you can see that it's a lot shorter. So it gives you an early entry trigger, but it also means that it can flush around before it gets going. Now, once it actually does that longer time development, retest that 76.4% again, then that gives you a much more solid move to tell you that, this time development is really now at the perfect location. So here's an example actually from yesterday, and this is the S&P 500 futures on the 300 tick chart. So usually with the S&P, I'm focusing mostly on day trades. I'm usually looking at smaller intraday time frames. Michael asked, do I always use a tick chart? Absolutely not. So this pattern will work just as well on a time frame chart as it does on a tick chart. Now, if you look at both of them, usually when I'm trading futures, I will look at both because I might see a pattern develop on one that is not developing on the other. So it gives me an opportunity to kind of, double my scanning power, I guess, just trading the future. So I will look at both time frame and tick charts. Now, intraday, when it comes to actually timing the trades, I usually fall back onto tick charts because I can see the swings in the market a little bit better. So what tick charts do I use? That's actually a good question because it depends upon the security. So like for the S&P 500, the ES, for those of you that trade ES futures, I will use the 500 tick is usually the lowest, but sometimes when I'm timing and I'm just scalping, I'll go a little bit smaller, usually the 500. Whereas in the NASDAQ, it would be the 200. The Dow, it would be the 100 and sometimes even the 50. Each of your forex pairs is going to be a little bit different. Each of your stocks is going to be a little bit different. What you want to do is you want to get a time frame where you can see back and forth movement easily. So Bob asked what a tick chart is. A tick chart is basically just showing you every single trade that's happening. So it shows you things that are happening overnight, for example. If you use a time frame chart, you're not going to have much activity overnight. So with a tick chart, it kind of squishes all of that together so you can get some smoother movements and smoother patterns. So when we go back to my trade here yesterday on the S&P 500, this is the ES again. Here's another example of using the Fibonacci fans, and it shows you in a little bit more detail. So I didn't go from this low to this high to add the fans on because that would mean that this is a stronger than average move. Instead, I went from where it hit the support the first time. And what that does is that gives me a more solid, slower, more gradual, average momentum move compared to what we see in the past for average moves. So then when it came into the 76.4% zone, this was still too early for time development because when I look back in the past at other periods of where I look at this impulse move and how long it takes to correct, it wasn't long enough of a correction. So what we needed to do instead was wait. And I also wanted to wait for the momentum to shift. So we're actually trading at highs on this one. So this is an example of where it had been coming out of a longer uptrend. And we just started to get a correction intraday. And so what we needed to see was some sort of shift in momentum that would tell me, you know what, this isn't just going to be, something that's going to lead to a reversal later on. It's something that we could still get another decent pop as just that secondary move. Now, because this was further within an uptrend, and this is part of just a corrective move in that uptrend, it can limit the potential. So I went into this looking at this for 100% extension as a target level, and I'll explain that here in a second. But I'm also going to show you how I ended up managing this because things shifted as it started to follow through. But it just gives you a really good recent example of this trade. So for an entry on the Phoenix, there's several points that you can use as an entry. The first one is to look for that two-wave correction and then take a channel break as it comes off of that second move. Now the thing is that if the second move is as fast as the first one, you might get another shift to kind of change that momentum a little bit to get a stronger breakout. So this happens when the time development might not be as perfect here. It might be hitting that 76.4% the first time for a fan, or it might be like 2/3 of a previous range or previous consolidation. And so that's the most aggressive type of entry to start with. And usually that means that that downside move has momentum that's similar to this upside move. So it might turn into like an inverse head and shoulders, for example. That's one way that you will see that develop. Now, the other option, which is much better, is that if you do see something like this, look for a smaller phoenix within that move. Now, in this case, we have both at once. So the second wave here is actually this little two-wave correction, and it has this smaller phoenix within the larger phoenix. So in this case, both of those entry strategies takes place at the same time. The stop level is under that last pivot low. So if this was a two-wave correction where you had a lower low, you'd have to use under that low if you are buying a break in the channel from coming off of that second low. If instead it formed over here and did another Phoenix before it went, you would use a stop under that last low. So I'll clear this up and draw that up here for you guys. So basically if it goes like this, you use a stop here, entry here, stop here if you're just using the two-way channel break. And then the third type of entry is using the entire channel of this entire Phoenix. So sometimes what you'll notice is that a Phoenix isn't as clear cut here. It might mess around a lot, not give you, a smaller time frame setup, a smaller shift in momentum. It might just kind of, play around in here, and you don't have that opportunity to get in with a smaller setup. So in a case like that, I will keep my stop under the entire low of that channel, use a breakout in the upper end of the channel. The problem with that type of a setup is that if you're coming off of a low, when it comes and breaks that channel, oftentimes it's been moving. So you'll have strong movement from the lower end of the range right up through the upper end of the range. Many times it actually pulls back right away before it turns and takes off. So sometimes I know my traders that follow me live will see me buy as it's pulling back into that congestion. But that pure channel break is another kind of last ditch trigger. Like if you miss the earlier triggers, it's another one to look for. You just have to watch how does your return potential compare to what your risk would then be, because with the Phoenix, you do not want to get too aggressive on changing what your trailing stop level is going to be. Because if you do get too aggressive, you're going to get flushed out very easily. So here's another example that shows those channel breaks and some of the risks that can be involved when you just take a pure channel break. So if you just take like the two-way break, you'll see that if it has to run from the lower end of the channel up to the upper end, sometimes it can pull back into that range. So a lot of times when I see this happening, I'll actually buy it as it's pulling back in, but I'm keeping my stop under that last pivot low. So this shows you a couple of variations. Now let's get to the target level. So the target level on a Phoenix is really simple to discover because all you're doing is you're looking at the impulse move here from the low to the high, going to the last low where the momentum starts to pick up and leads to a breakout. And the target level is generally going to be 100%. Now there's a couple of things to watch for here. When you have a Phoenix that is part of a corrective move where it actually has downside potential later on like this did, this is the one that it was in an uptrend here, broke the uptrend. So now you have the risk that this is a two-wave correction as part of what can kick off a newer downtrend. Then you want to watch how it starts to play out, because it becomes harder for it to hit that 100% level as easily. So as long as the momentum starts to break out with the Phoenix pretty easily, I'm still going to go for that 100% level. If it pauses a little bit short of it though, like at the 76.4, I have to be prepared that the channel can shift. And this is where trade management comes into play. So with trade management, what we are now going to do is we're going to take that last major pivot low in here, connect it to where that pause is, and here's the entry trigger here. And what you'll notice is that once it puts in this low, at that point, you can start to adjust a trailing stop where if it breaks that channel from here to here, that would get you out of the position. So that's kind of like your last resort exit. So if you miss getting out and taking gains at any earlier spot, that would be your last resort exit. So that's like this pattern is done for. Don't try to hold for any more because it's going to put in a larger correction. So what you'll want to do is look for a target level. It's 100%. In this case, it fell just a little bit shy of it. but then it went and tried it for a second time. So a lot of times these phoenixes will have two waves up into a range, they'll have a two-wave correction, and then they'll have a two-wave breakout. So what I usually do is that if I get a pullback that is stronger than I was expecting, it doesn't quite hit where my target level is going to be, I'm looking to get out into that next push higher. And I'm usually dropping down to the smaller time frame and looking for two waves, and that's going to help get me out at a stronger level. At that point, you can even tighten up the trailing stop, where if you have your target on the books, you can also look at this low and this low. And if that breaks here, that is another kind of a do or die trailing stop, where if you weren't fast enough to get out at this level and it breaks through that support, then it's done. You want to just take whatever gains you have left. So in situations where, you know, it doesn't go as fast as I'm expecting and doesn't do quite as much as I'm expecting, then these are ways that you can manage the risk that you don't end up with major losses on the position if it turns around against you, even if you don't quite get what your target levels are. In this case, it does hit the 100%, which is great, but because this is a counter trend move and trying to kick off a new downtrend, there's the risk it might not do that. So going into the trade, I knew that that greater risk was there. In cases where you're coming off of, and it's actually a reversal of a much larger trend, you don't have that much worry. You don't have to be as concerned. Now, in cases where you have that larger trend, like a stronger downtrend here, you have that shift in momentum. This was that inverse head and shoulders that we looked at earlier, then you have a lot more potential for movement. And you can set your initial target levels at that 100% level, but you can usually get a lot more out of the position. So then you have to decide, well, are you just going to be like a scalper, day trader? Are you going to hold with some of the position, go for larger target levels, maybe add back in? A lot of times what I do with things like this is I'll take off some gains at certain points, and then I'll add back in at other levels if there's continuation plays. This is a good example of how that larger trend will give us a stronger trend reversal where we can actually get substantially more out of the position than that 100% level. So I'm going to show you guys that trade from yesterday and what the management meant on that one. So when we were coming out of this Phoenix yesterday, my entry trigger is here, my stop trigger is here, and you'll notice it hit that 76.4% again. And it did it with slowing momentum. So it was really struggling to try to get to that level. Now, in the ES is one where a lot of times my Phoenixes are setups where I might only get like 0.75 to 1 return what I'm risking, but I know it's a trade that when I'm scalping them, I'm going to get that amount at least 90% of the time. Now, in other securities or trading on larger time frames, you can get much better return compared to what you're risking. But in the ES, I know that's pretty typical. When I'm going down to like a 500 tick to 300 tick, that's going to be normal. And it's just because you get bigger ranges compared to the impulse moves. So every security or trade is going to be a little bit different. But the follow through on this is, again, really typical. So we were dealing with a market here where this had come out of an uptrend already, and it was starting to shift momentum going into the highs. That meant that a Phoenix at this level was a bit more risky because it's coming out of a correction that's offering a continuation, but the larger trend was already showing exhaustion. So I knew that I had to be on higher alert, that I might not get the full target levels I was looking for, and I would need to manage the position a little bit more carefully. As you can see, this did end up going to the 100%, and in fact even went to the 123.6% level, but I did take off a little bit of the position right in here because things were starting to slow down. And what I was concerned about was that we might get a type of double top and lead to a reversal at that point. So that's what I started to watch for, something that could actually potentially reverse the position. But here is what you would have done as sort of last-ditch management if you missed out on getting those target levels. So when this continued forward, what I watched for was looking at this low to this low here, connecting those, and then drawing where a projected parallelogram level would be. So because this fell short of my 100% target immediately, this was a zone that had the risk of serving as the next major resistance level that could in fact turn that channel around. So as it started to come up into that level, had an initial wave, secondary move, got out of the position. If I had missed the exit though, this is where you end up in a situation where Phoenix doesn't often take full stops because you are able to adjust the stops pretty quickly to move them to break-even levels or a bit above break-even levels, but I never use it as a pure break-even level. I always use it as a technical reason. So for example, just like I talked about earlier, when this level has a low and this level has a low, I draw that out. That becomes my next adjusted stop level once this bounces here. Instead of using this stop here, my stop is now up to here. Notice that that corresponds to the break-even point, but it's not always going to be specifically that break-even point. I will never use a break-even point specifically because it is a break-even point. There has to be a technical reason for it. Now, as it goes forward, you can see there's another two-wave move here. So you can also use that, and that can become another do or die position where, like, let's say maybe you held on to some of the position and you were looking, for even greater strength on it or something. If it breaks that level, then it's pretty much guaranteed that it's going to do another move on the downside. Where if you got one leg here, you'll get another leg to the downside. So you've got to watch for that and be prepared that if you don't want to hold for that next leg to the downside, that offers you a really good level that you can adjust your position on the rest of the trade. So these are really good really good ways that you can manage a Phoenix where even if you somehow bungle up where to get out of the trade, you can look for very technical reasons for where your support and levels are going to be to help keep you in the position to still try to get more out of it. But at the same time, these are the techniques that you need to use to avoid just getting flushed completely and have it totally turn around against you. Another way that I use a Phoenix is when I am doing gap trades in individual stocks. So a lot of times, especially now since we're in earnings season, you will see securities that are in periods of congestion, that they've been basing out on the larger daily time frames. And what I'm doing in pre-market is I'm scanning and looking at the daily charts for things that have come out of these downtrends, that have been basing preferably with declining volume or weaker volume, and then offering that potential for that breakout. Sometimes they've already started to break a little bit, like we saw with CMG. This is one from our trading room a week or so ago. And sometimes they're already starting to break out. But when you get a breakaway gap that is coming out of a Phoenix, these are securities where you will have usually really strong continuation out of the open. Sometimes they barely pause before they keep going. So you might only get a pause for like a few seconds and then the trend will continue. Zebra is one we were looking at yesterday. Let's see if I can show you guys a version of that here quick. So it was actually not quite a Phoenix, but you can see, really similarities. If this had happened, down here, after this is coming out of a channel, that would be your Phoenix. You're looking for that breakaway gap move. Basically, it's just where the momentum of the gap helps propel that move higher. So with this type of breakaway gap, I look at this impulse move over here. I look at the gap size. If it's not on the extreme side already where it hasn't gone like 123.6 or something % compared to this upside move, then it is a great position to look for continuation right out of the open. So you will see that on CMG. We saw this here just this morning on BIO. So BIO was on my pre-market list here today. And the reason this caught my attention was within this channel, it had this pullback and the gap broke it out of that range. Hold on just a second, guys. I'm going to grab a sip of water again quick. All right. So when we look at, the size of the gap on BIO this morning, compare it to the move going into the gap, there's plenty of room for this to move this morning. A lot of room for this to just really keep going. In this case, I entered this really early on in the day, right out of the open. BIO is kind of thin, so it's one that you kind of have to jump on. But you can see it has a history of really following through on its gap trade. So here's an example of down in here we have a first little phoenix, just a really small kind of starter one. And then we actually had a larger phoenix as part of a bigger cup with handle for the gap that took place, leading into this period of congestion. So the fact that both of those worked out so well, and we now had this larger channel where it only had one move on the upside within the channel, the pullback, and then the breakaway move, I knew that we would at least get a move back up into this zone of prior highs for a target level. Not sure where it's gone since then, but that was my target level on this trade. And I just grabbed the screenshot as that took place. So I want to thank you guys for joining me here for today's session. I'm sorry, I'm kind of losing my voice off and on here today, trying to beat this cold, but I don't know, it's kind of beating me here up a little bit too. But I want to share with you guys a market timing boot camp that I've done. I was actually supposed to retire this boot camp last week, but Jeanette convinced me to offer it here to you guys again today for today's session as a special. So my market timing boot camp actually goes into a lot of the stuff that you see here today, that I talked about, the building blocks of price development. Those are those things that when you are creating these strategies, things like momentum, time development, trend development, they all work together to create a pattern and to tell you what the odds are going to be on those patterns. So like when I talked about the Phoenix, I talked about 3 places that a Phoenix is ideal, and then the situations where in some cases the Phoenix is going to give you a trade, but it might not give you as much as you're hoping for going into it. And so you have to be able to adjust how you manage the position. So something like that, it's really important to understand what those building blocks are that create those changes that would lead to another pattern that would lead to less return than you're expecting or would lead to more return than you were expecting. So the Market Timing Bootcamp is 6 weeks of self-paced video sessions, 2 to 2.5 hours each, and it covers all of those aspects that go into my style of market analysis in very great detail. It goes into each of those things like time development, very specifically, and then it goes into putting them all together to create strategies like the Phoenix, like a number of the other reversal strategies that I use as well. Helps you understand in which circumstances one pattern is going to be more likely to form than the other, and even what next series of patterns are going to follow. So I know some of you here, I actually see you in a lot of my live sessions, and you see where I will give like a Phoenix, and then it will go into a bull flag, and then they will go into a momentum reversal, and I'll basically show you guys a complete series of patterns to follow. And that's because I'm looking not just upon patterns as snapshots in time, but I'm looking at how they take place within the overall market, looking at, how trend development is going to affect a Phoenix. I see a lot of traders teach specific strategies But they don't teach you the variations of the strategies, how those strategies are going to change as the market changes. The Phoenix is very adaptable. It is something that you can trade in a strong trending market, and it is something you can trade in a volatile range-bound market like we've seen on the monthly chart since February. So it's, I highly recommend you guys, take the last chance here to get involved in this boot camp. I've included my market timing playbook, which is a PDF that you can print out. It's over 200 pages that goes through each of my strategies, talks about the building blocks of each of the strategies, and then gives you examples of trades. Not just the picture perfect trades, but it shows you things where every trade has pros and cons, and in which circumstances do the pros outweigh the cons and vice versa. So there's examples of multiple trades for multiple strategies, and it shows you what the pros and cons are for each of them. I'm also including my 5 technical signals you cannot trade without textbook and worksheets. That's another 250 pages, and it's an actual college textbook. So it goes through everything from the very, very basics of understanding technical analysis to going into a lot more of the advanced concepts that you guys see me touch on today. It even includes things like gap trading and how to trade gaps. So you guys can pick up this entire market timing bootcamp for $197 for just today. We are wrapping up this bootcamp here. I'm going to be doing another one in forex in a couple of months, but this is going to be the last time that you're going to have a chance to get this entire market timing bootcamp. And it goes through, again, my entire type of market analysis, my entire system for how I trade, goes into the details of things like the Phoenix that you saw me trade today, as well as multiple other strategies. And there's even a section that focuses purely upon trade management. So it's only looking at how to manage positions. And I showed you guys a little bit of that here with the Phoenix, but it goes into it in greater detail of a lot more securities as well. So I'm going to go through here, check out a couple of your questions. I think we're running out of time here a little bit soon, but let's see what we have here. Oh, thank you, Sean. Can this be applied to Forex as well as equities? Absolutely. So I trade both futures, Forex, and individual securities. Oh, hold on a second here, guys. Jeanette is telling me I actually have until 1:30. Woohoo, we can talk more. Is this available for lifetime viewing and studying? Absolutely. So you can go and access this anytime. We've actually completely redid my website. So ToniHansen.com has a brand new look, and all of the courses are being switched over there. So you're going to have lifetime access to it. So you can go back, study it anytime you want. You can ask me questions anytime you want as well. We can go and switch over here to look at some live charts as well. And you guys can ask me anything you want about some of the live markets too. Let's see here. I'm gonna go through some of your questions. I have never looked at tick charts. Is there a benefit to using them versus, say, a 15-minute or greater time frame? Absolutely, there's a benefit. So when you're looking at something like the S&P 500, now it might not make as much of a difference if you're using if you're trading with say individual stocks during the day. It might not matter as much because when you're going and looking at individual stocks during the day, you're not really caring as much about what's happening after hours. There's not as much activity as far as like aftermarket and pre-market trading. So it's not going to skew things a lot, but when you're trading futures, it can make a big difference. So like if we look at, I'm going to show you guys here, this is the 120 on the ES. And then if we go and pull up a tick chart, I'll just show you guys, like I'll make this a bigger tick chart. What you're going to see is that the type of data that it displays, the type of patterns that it displays are going to be different. You're going to see patterns that will look a lot differently than they do on an individual time frame chart. Well, I'm having a little trouble getting that pulling up really fast, so let's go and look at the 2500 instead. So we'll just look at today's data. I'll switch this over here on the 2-minute chart to look at the same bit of data here. And what you'll see is that I think it's because I've got a lot of things here running at once. But what you're going to see is that they look very, very different. Here's a 5-minute. And it's mostly to do with when you're trading pre-market action. So if you're looking at trading pre-market action, then a lot of times things will smooth out differently. So when we look at early action here this morning on the tick chart, and you see this back and forth movement, you can see that it's a lot smoother on this 2500 tick chart. Whereas when we look at the action on the 5-minute chart of the ES, look at how messy this gets. You know, there's a lot of back and forth from one bar to the next, and you just can't see the waves of movement as easily. So comparing those, I will always use the tick chart to help me get a better feel for what's happening. But when it comes to looking at larger patterns and larger price development, if I see a pattern that's forming on like the 120-minute chart, and I'm not seeing something on the 3000 tick chart of the ES, I will often fall back on what's happening on the time frame chart because that can give me a little bit of better feel. For example, here's this little phoenix here on the 120 on the ES. And you can see it looks picture perfect. Well, when you look at the tick chart, it doesn't look as picture perfect as that. So I definitely go back and forth when I'm trading futures. Again, it doesn't matter as much when you're trading individual stocks though, unless you're doing, maybe if you're doing some gap trading, you might want to pay some attention to what's happening in pre-market activity. Can you use your strategy to determine gold direction? Absolutely. Gold, oil. Actually, we had a beautiful short on oil yesterday that was an avalanche, which is the reverse of a phoenix. So an avalanche just takes the phoenix, it turns around, flips it over. Let me see. I've got a screenshot actually. Show you guys our trade here that we did live yesterday. So an avalanche is just looking for that first movement after you've got a downside move here. You get that period of correction, period of congestion, and then it triggers a short. We were just looking for the gap closure zone on this yesterday, out of it ahead of Trump's little news. But let's see here. I can show you the follow through on that one too a little better. So here was our trade we did. And the entry that we took was right up in here. We actually started watching it here because it had already had kind of two waves. It was a little bit messy, not as, again, not the textbook strategy that you'll have, but we used this last pivot channel break on a smaller time frame as the entry trigger because the momentum was shifting on that time frame. Another option would have been to use this, pure channel break. A lot of times, though, that can go really fast. It can be harder to catch it But this just shows you the pattern in reverse, and it shows it on a different market. So in this example, we were trading oil intraday yesterday morning, but the same can be said with gold as well. Michael asks, I trade a lot of options. Do you cover application of your trades as an option strategy? I don't personally get into teaching options, but probably about half of the traders I work with are options traders as well. So what I teach with regard to options is how to determine when prices are most likely to hit specific target levels. So what that can do is it can help you determine your strike prices, where your, which type of option strategy you want to get into, which expirations, things like that. So for example, when we're looking at the avalanche, when you're looking at oil, we were looking for this to actually pick up momentum and to hit the levels pretty quickly. So we go into not just, where the target levels are going to be. We look at, where the closer targets, but also where the more likely longer targets are, and then how long it's going to take to get to those levels. Guys, got a couple of questions on, again, how to pick up that course. So I'm going to type that in here for you in the chat box. It's tonihansen.com/timing. So let me grab that link for you guys. And if you have questions, going through the course, it's self-paced. It was created as 6 weeks. Some people blast through it, and some take a little bit longer. But there's the link for it. And again, it goes from everything to the very basics, understanding like those key things that go into the creation of the pattern and then the patterns themselves. So you're understanding, you get to understand basically what momentum is and how to read momentum regardless of what strategy it is you're trading. But momentum will determine what your outcome of a strategy will be. So maybe you trade like ABC patterns. Well, the understanding momentum is going to give you a clue for how to place your target levels and whether the strategy is going to be viable or not. So hopefully that makes sense with regard to your question on what, building blocks are going to be. Can I show you guys how to draw the Fibonacci fans? Absolutely. So if you're on TradeStation, what you're looking at are these trend moves back and forth in the security. Now, in order for the fans to work well for something like a phoenix or an avalanche, if you're flipping it over, you want to look at average momentum moves. So that means that if a move is stronger than average, your levels probably aren't going to work as well. So if we're looking at something like for an avalanche, for example, if you're going from the high to the low, this would be an average momentum move because you've got a lot of overlap from one bar to the next, and compared to the upside, this looks pretty close to a V. So that becomes a good level to draw that Fibonacci fan. What you'll notice here is that this went more quickly than the ideal. It went off of the 61.8% fan. What that means is that because the time development is not quite there, ideally it would go to the 76.4, it runs the risk of pulling back up, correcting. Sometimes it'll go like this, sometimes it'll go like it did before it picks up momentum. So a lot of times your people will be looking for, 100% measured move target levels, and it won't go to that target level. It'll go down and it'll pause. That's because the trend development, as far as the time development, wasn't there yet. So the pattern broke too early. It triggered this avalanche too early. This could have just as easily gone to here and then popped back up. People that would have shorted this kind of got lucky, actually, that it went as far as it did, because in many cases that just won't happen. It can go to a slightly lower low and then pull back up into the channel. So the low risk entry is when it does hit that 76.4. So this is a variation of your avalanche. It's just it took a little bit of a different scenario for it to form, but it's still the same concept. And that's what's really important to understand when you're looking at things like the phoenixes and avalanches, is you want to understand what the main concept of the strategy is. And there's lots of variations with every strategy you trade, but once you understand that core concept, the core template, you'll start to learn what those variations are. I obviously go into a lot of teaching of what those variations are, but this helps you develop a better understanding. So when you're using something like the fan and it goes early, it doesn't mean that there's still not the potential. It just means it might have to bounce back up first before it gives you the continuation, and that becomes a situation where I say, okay, you know what? Doesn't quite go to my target level. I might still be stuck in it. I'm going to just keep holding on versus bailing on it because it still has the potential to go. So that's how the fan can come into play, not only with like timing the entry, but also, you know, adding levels where it's still a viable trade. Question, are Fibonacci fans available in MT4? I'm not sure. I know some of my clients have programmed it into NinjaTrader, so there's certainly the ability to add them to a lot of platforms, but sometimes they have to be done with a plugin. So a lot of platforms, it's still not standard to have it in. I know TradeStation is standard. NinjaTrader, you've got to add it in, but I'm not sure with MT4. For Toni, I see that you have tick charts in thousands. That means 5,000, for example, is equivalent to daily candle bar chart. Marcello, it can vary. So it depends upon what the security is that you're trading. So let me show you guys just a really good example. As time frame charts, you can't easily translate them to a tick chart because every one is going to be a little bit different. So if we look at something like, let's find something that's kind of a bit thinner. So this is a 2,500 tick chart on ERY, all right? So 2,500 tick chart, you can't even see movement on this intraday. If you look at a 2,500 tick chart on the ES, on the other hand, you're going to see a lot more. So here's the 4,000 just from today. I'll change that even to 2,500 so you guys can see the difference. So what you'll see is that you have clear-cut waves on a 2,500 tick chart when you're looking at the S&P 500 futures because there's a lot of volume traded in it. When you're trading ERY, there's like hardly any volume. So it doesn't become something that you could trade as easily on a tick chart. Here's a 50 tick chart of ERY, and we still haven't shown as much data as far as many bars are. We go down to probably like the 2,500, 25 tick chart. Then you're getting a little closer. So 2,500 tick chart on the ES, when you translate that into a time frame chart, it's going to be totally different than what it would be when you're looking at something like ERY. So hopefully that gives you a really good visual comparison there that you guys can see. So in this case, ERY, your 25 tick chart's probably going to be about close to what a 3-minute time frame would be, maybe even a 2-minute. Whereas for the ES, 2500 tick chart, it's going to be close to probably about a 15-minute. So you can see about the same amount, maybe 10. So yeah, big difference, and each market's going to be a little bit different. When you're trading gap trades, it's really important to go down to the smaller time frames because if you're trading like Amazon, for example, you might be able to trade that perfectly well using a 100 tick chart when you're doing gap trades. But if you're trading something like BIO this morning, like I had here, I'll show you guys that BIO. Here's the 2500 tick chart on BIO today. Now, I had to actually go down to a 10 tick chart on BIO because when I used anything bigger, you just couldn't see any movement. So I loved the daily chart on this. It had that great Phoenix I showed you here. Here's the daily chart. But to time it, I had to go down to the 10 tick to see this early congestion and to take that breakout there. Oh, you're very welcome, you guys. Can you do this on the Dow spot? Absolutely. You can even do it on the dollar index. So you can even trade the dollar index and get the same thing. Actually, the dollar index this morning had a Phoenix. I'll show you guys some more, make it go back a little bit further, but I was looking at this morning because it had a really nice head and shoulders, inverse head and shoulders. So here's the same strategy that we just looked at, and very clear time development. So notice how close that fits to what we were looking at earlier. I'll show you guys that on, let me find the PowerPoint slide and then show you guys the comparison here. So again, yeah, it's tonihansen.com/timing for my course. And I'm going to scroll back and find that slide and show you guys exactly what this means to when I say this can be applied to any market, any time frame. It's actually one of my very first slides. It's this market right here, but I'll show it to you on a bigger slide. Dum 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 dum. Ta-da! All right, let me make this smaller. Oops, well, here. There you can see it. Well, look at this right here. I'll do a screen capture. Show you what this is. This right here. And then we'll look at it right now with the market in the background. So again, this is from the NASDAQ. Last time I gave this class, this is a trade we had in the NASDAQ on, it was the 25th. And then today you have the exact same pattern repeating itself on the dollar index this morning. Kind of squish this down so you guys can see a little bit better. Oops, it's already squished as far as I can. I'll just make it a smaller tick chart, 15. So there you go. Notice it's exactly the same pattern there. And if we put our 76.4% fan on here, which you'll notice, I'm going to go to the absolute low here. What you'll notice here is that I talked about earlier how it's important that you have an average momentum move to use that 76.4% fan, because if the momentum is stronger than average, like you see here, it doesn't work quite as well. So you'll get the 76.4% might hit, but you also want to watch for something else that's going to give you help with the trigger. So looking at, for example, the time development here, comparing that to that, that's going to give you that better idea of where that actual pure continuation move is going to be so that you don't get in too early. Oh, thank you guys. I'm so glad that you loved today's session. Do you have any other questions for me? Yeah, I posted that in the room. Let me go ahead and pull that back up for you again. It is just tonyhansen.com/timing. We'll go back to that. Thanks for sticking with me today here, guys. Thought I was going to lose my voice here when we got started. I've answered a couple of your guys' questions that are kind of off topic here in the Q&A box. So if you have like questions on other things, I've posted the answers there for you. All right, guys. Well, thank you all for having me here today, and I hope you enjoy the rest of today's presentations, and I hope to see you all soon.